Hello, friends. Welcome. Before I sat down at the microphone today, I did some thinking. I looked at my own trading history, my trader friends around me, and the conversations revolving on social media, Twitter, and Telegram groups. What is that one sentence we hear most frequently in the market, the one that is repeated the most? I am sure you all know it. The same question is on everyone's lips. Sir, is the trend over? Are we turning from here? Has the crash started? Sounds familiar, doesn't it? Everyone is trying to catch that magic moment, that peak point where the trend ends, or that bottom point where the drop stops. However, there is a painful truth, and we need to talk about it. The vast majority of those asking this question actually have no understanding of when, why, and how that trend started in the first place. Unfortunately, human nature works like this. While the price is lighting up green candles and rising, they sell early out of fear to take profits. When the price turns red and falls, they trade in the wrong places out of panic, fearing it will drop further or hoping it will turn from here. In short, they are not reacting to the chart, but to the knot in their stomach, their emotions, and their excitement at that moment. And the result? Inevitable frustration, melting balances. Right here, today, amidst this chaos and information pollution, we are going to talk about a man who takes the stage, Charles Dow. Charles Dow was not a trader, friends. Let me state this from the start. He was not someone who traded with a stopwatch in hand, stayed up all night in front of screens, or mashed the buy-sell buttons. He was the greatest observer history has ever seen. But today, in 2025, he laid the behavioral foundations of everything we use on those complex charts open before us. Yes, the foundations of technical analysis. Because he was the first person to realize that price is not just a number flashing on the screen moving randomly, but actually a graph of human behavior, a map of collective psychology. Grab your coffee today and lean back, because we are embarking on a deep and eye-opening journey that stretches from the dusty Wall Street streets of 100 years ago to today's high-tech crypto market, from Dow's simple observations to modern CTA algorithms. First, let's get to know this man, this genius. Who is Charles Dow? Born in 1851, a journalist from Connecticut. He wasn't someone who talked a lot, walked around aimlessly, or put on a show. He was quiet, dignified, detail-oriented, a true observer. Most of you probably know him from the Wall Street Journal, which he founded, or the Dow Jones Index you still hear about in the news. But believe me, his real legacy is not these companies. His real revolution was the notes he hid between the newspaper columns he wrote at that time. Back then, the market was like the Wild West. Manipulation, fake news, and chaos reigned supreme. Dow watched this chaos and believed this: price is a cocktail of news, expectations, fears, hopes, and greed in the market. People dance with the price. And Dow watched this dance for years. He wrote no mathematical formulas, established no complex equations. But when he died, he left behind a system of thought so profound that Hamilton and Rhea later compiled it and called it what we all know as Dow Theory. The trend lines we use today, those supports and resistances we love so much. This theory is the father of them all, the origin of them all. So, what did Dow say? Let's look at the 6 cornerstones of the theory one by one, digesting them and adapting them to today's most volatile market, the crypto world. Rule 1, and in my opinion the most important: the market discounts everything. We might as well get this tattooed on our arm or write it on the edge of our computer screen. Price is the total summary of information, emotion, risk appetite, and even news you haven't heard yet. Sometimes news breaks, and you expect the price to fly or crash, but the price doesn't budge. And you say, wait, why didn't the price react? This news was very important. That's where you are skipping the first rule, because that news was already known by insiders, by market makers, and was already priced in. This is the same in crypto. On-chain data, macroeconomic developments, sentiment on social media, it's all in the current price. So my advice to you, don't go from news to price. Try to understand the news from the price. Price is the distilled form of news. Rule 2. There are 3 trends in the market. Dow explains this with a wonderful analogy. The ocean. First, the major trend, that is the main current, the tide. This is the big story. The bull or bear season that lasts for years. Second, the secondary trend, meaning the waves. These are the sharp corrections within the main trend. And third, the minor trend, meaning the ripples on the water. Intraday noise, momentary price movements, those little zigzags. Look, this is vitally important. The minor trend, those ripples, deceive the daily scalper, exhaust them, and melt their balance. The secondary trend eliminates the impatient investor, throws them off the trend. But the only thing that will truly make you rich is the major trend. Speaking for crypto, Bitcoin's 4-year halving cycle is the major trend. Those 20 to 30% corrections we take in between are secondary trends. Those who sell thinking the trend is over during those corrections are the ones missing the big picture. Rule 3. The major trend passes through 3 phases. This is the very heart of human psychology, of that cycle. Listen carefully. Think about which phase you feel you are in. First phase, accumulation. Smart money. Institutions collect goods quietly here. Volatility is low. Price is sideways. No one talks about Bitcoin. Everyone hates the market. Second phase, public participation. The trend becomes visible now. Charts turn up. Twitter influencers start shouting. News channels talk about Bitcoin. A feeling of easy money spreads around you. Everyone is winning. Third phase, distribution. This is the dangerous zone. The moment when everyone on the street, the taxi driver, the barber talks crypto. The place where they say, "This time is different. We will rise forever. We are going to 1 million." This is exactly where professionals sell their goods to novice investors caught up in that enthusiasm and quietly exit. While you are experiencing euphoria, they fill the safe and leave. Rule 4. Indices must confirm each other. Back in the day, Dow used to say if the industrial average is rising, the transportation average must also rise. His logic was simple. If the produced goods are not being transported, the economy isn't really growing. What do we do today? Is Bitcoin making a new high but altcoins are crawling? Is Ethereum not accompanying it, or is the total market cap stalling? If only a single instrument is flying but the general market, that is the market breadth, is weak, that trend is fake, it is fragile. If there is no confirmation, there is no health in the trend. Rule 5. Volume must confirm the trend. This is a very technical but very simple rule. As the price rises, volume must also increase. This shows that participation in that rise is high, that there is plenty of fuel. If the price is making a new high, breaking a record, but volume is falling, be careful. There is exhaustion there. Buyers are reluctant, but sellers haven't arrived yet. This is a trap. Volume is the greatest detective testing whether the price is lying or not. And Rule 6, trends exist until definitive signals prove that they have ended. Do you know the most expensive mistake investors make? Opening a reverse trade early, shorting, saying, "Price has risen too much, this is definitely the top, it will turn from here." Dow says, the market works like a law of physics. An object in motion continues its motion until it encounters an obstacle. Do not believe the trend is over without seeing a structural breakdown. That is, a lower high and a lower low. A single wick, a single piece of bad news does not end the trend. Only structural breakdown ends the trend. Now, up to this point, we talked about the theory and history of it. You might say, "Okay, sir, these were 100 years ago. So, how do we use this in 2025? With the AI-supported computers and algorithms we have, is Dow still valid?" I answer, absolutely yes. In Dow's time, there was no data, no computers. There was only price, pen and paper, and people. Today we have volume price momentum, VPM, analysis. We have funding rates, liquidation heat maps, open interest data, second-by-second data flows. But believe me, at the end of the day, they all measure one thing, the same thing, human behavior. The CTA strategies we use today in the modern algorithmic trading world are actually the digitized, coded versions of Dow's old theory. For example, Dow used to look at the chart with his hand and say, "Accumulation phase, price is compressing." Today we call this volatility compression algorithmically and measure it mathematically. Dow used to say energy is accumulating in the market. Today we measure the speed of that intent in price, the intensity of money inflow with flow-adjusted momentum. Look, let me give you a very interesting detail. In modern systems, there are highly advanced algorithms we call regime switch. These algorithms measure whether the market is in a low volatility regime or a high volatility regime. Dow did this 100 years ago with his intuition and observations. Today, we do it with math and standard deviations. The goal is the same, to understand not just if the trend is up or down, but how much load it can carry on its back, to understand how real this trend is. Let's make this a bit more concrete so you can visualize it. Imagine two scenarios. Let one be on Bitcoin and one on Ethereum. Remember that boring period in Bitcoin pre-halving. Price goes sideways for days, weeks. It's boring. No one talks on social media. Newspapers run headlines. Is Bitcoin dead? Did the crypto bubble burst? This is exactly where our VPMV score, those modern algorithms, whisper to us. Momentum looks weak, but energy is compressing, meaning a spring is being coiled. Volume is low but stable. Open interest is constant. Funding rates are neutral. The novice trader looks at this, gets bored, and says, "The market is too weak, there is no movement, let me sell and get out." But an algorithm with Dow logic looks at this and says, "This is an accumulation phase. Smart money is collecting, wait and be patient until the trend is confirmed." Then what happens? That breakout comes. The spring snaps. Public participation begins. Everyone tries to enter at the top. History does not deviate, only the players change. Let's look at the Ethereum example, specifically that painful situation we call the bull trap. The price has been compressed for a few days. Suddenly, aggressive long positions are opened, green candles are erected, funding rate turns positive, open interest spikes. Twitter explodes. ETH is flying, altcoin rally is starting. But we look at the data with cold blood. Is there a real buyer on the spot side? Does volume support this rise? Or did just leveraged gamblers get hyped? Usually the answer is the latter. There is no spot buyer. Dow would call this deceptive enthusiasm. The price throws a hard wick up, sweeps the liquidity there, and then crashes down with a very harsh red candle. Thousands of people, millions of dollars get liquidated in seconds. This is where Dow's sixth rule saves lives. Don't jump without a structural breakout, without getting confirmation. That fake breakout is not the continuation of the trend. It is a trap being set. To wrap it up, friends, it has been a century since Charles Dow left us. The market has changed a lot since then. Technology has changed. People don't trade by shouting on the exchange floor anymore. Bots trading in thousandths of a second, AI models, and cold-blooded quant systems are fighting. But Charles Dow's legacy still lives on, even in the heart of those AI models that seem most complex and incomprehensible. Do you know why? Because at the foundation of all these models, all these charts, all these algorithms, there is one single unchanging truth: human nature, human fear, human greed, human hope, and panic. Dow put this on paper 100 years ago. Today we modernized it, formulated it, turned it into code. But the rules of the game are still the same. My request to you is, when looking at the charts, try to see not just those candles, not just the numbers, but the massive psychology behind them. Charles Dow's theory is not just a history lesson, an old story. It is an eternal compass for today's trader, for you, for anyone who wants to find their way in this chaos. That's all I have to tell you for this week. I hope I have made even a small contribution to your perspective. See you in the next episode. May the trend be with you.